Today, we need to talk about why a very small UK lender has major United States credit firms on the edge. They are stressed, and it has to do with bridge loans. So let's call this the bridge that broke. The thing about a bridge loan is that it is supposed to be temporary, a few months of breathing room for the borrower who is rich on paper but short on cash. A property owner waiting on a sale, a developer between deals, a quick money deal, high rates, a hard backstop of real estate underneath it all. The loan is supposed to be the plank that you walk across until the permanent financing arrives on the far bank. There's a company in the United Kingdom called Market Financial Solutions, or MFS. They built about a 2.4 billion pound business out of those planks, those short-term loans from offices in London run by a financier named Paresh Raja. MFS became one of the recognizable names in Britain's specialist bridge lending market, a corner of finance worth around 13.4 billion pounds. And this was at the end of 2025. It was the kind of place that borrowers go when the high street banks, the big boys, say no, and the clock for these investors are ticking. For years, the model worked the way it was supposed to. But then, on the 25th of February, the firm walked into an insolvency process, and the planks began to fall. Now, what investigators found in the wreckage was not a story about interest rates or a bad property cycle. It was a story about the collateral itself. And if you think this is just a United Kingdom thing, it's not. It's going to end up over here in America. You see, the central allegation is something the industry calls double pledging. We've heard this before. The same building, the same deed, the same bricks used as the actual security against more than one loan at the same time. A pledge an asset once and you pledge this asset once, and the lender, well, they do something totally different, right? They have a claim on it. You pledge it twice, 3 times, and you have manufactured trust right out of thin air. Sold the same safety to several people who each believe that they are the first in line. And when the music stops, the creditors reportedly faced a gap of some 1.3 billion pounds between what the collateral in the real estate was actually worth and what MFS owed them. Now, Raja, the leader of this company, now based in Dubai, has denied any wrongdoing. A failure like that in a firm most ordinary people have actually never heard of should, in theory, stay small, but it's not. And the reason it did not is the quiet machinery of modern credit. You see, MFS did not simply lend its own money. It funded its loans through layers, bank facilities, securitization lines from private capital firms, which we've been hearing lately are completely imploding. You see, each one of these industries stacked onto the last one. Money flowed in from some of the largest names in global finance, and when MFS went down, it pulled on every single one of those threads all at once. Within weeks, roughly a dozen financial institutions on both sides of the Atlantic found themselves tallying losses on a London Bridge lender. No pun intended. The numbers arrived during earnings season like a slow drumbeat. Barclays, they actually disclosed over a $228 million hit. HSBC booked a $400 million impairment. Its exposure routed through a credit arrangement tied to an Apollo-backed vehicle. We've heard Apollo in this news lately. Santander was understood to be in this for around 267 million, and then the American institutional names surfaced in the insolvency filings. Elliott Management at 200 million, Wells Fargo at 143 million, Jefferies at roughly 103 million, already carrying a $20 million loss, and smaller exposures at Avenue Capital and Castle Lake. Some of that may be clawed back in assets that may be recovered, but some of it will simply be wiped away. Real quick, I want to throw out an idea for you. I'm creating a program. It's a living course that I'm going to keep adding to. It is called the Creative Financing Course. It shows you how to get loans on properties and how to buy real estate in ways that the big banks don't want you to know about. Links down below. It's for a limited time if you'd like to check that out. Now back to this story. Because for any one of you that are watching the credit markets, the echo is unmistakable. Less than a year earlier, the collapse of First Brands, an American auto parts supplier, had sent a similar shockwave through lenders who thought they understand what they were holding, right? These two companies are very different, right? They're first off an ocean apart, but the same lesson is actually happening underneath. That the further credit travels from the bank that it originates from, the harder it becomes to see what is actually there. That is the actual anxiety the MFS affair has crystallized. Not a verdict on private credit as a whole. The industry is too large and too useful for that, but a sharp reminder of how easily risk hides when the data is scattered. One loan file lives with a manager, another with a servicer, and a third with the trustee. The cash in some financing vehicle, it becomes 3 steps removed, right? From people whose money is actually on the line. Each party sees a fragment. None of them sees the whole picture. And a borrower willing to lie can exploit exactly that blindness, pledging the exact same asset. In this situation, it's real estate, for multiple loans. I mean, this is absolutely insane. And this is where no single counterparty can quite see the entire picture, so it goes unrecognized for a long time. Now, the people who clean up after these things are already drawing the obvious conclusions. Lenders, they say, can no longer take a borrower's word for what backs a loan. They have to verify the collateral themselves independently and keep verifying it long after the money has gone out the door, because the failures, more often than not, happen after the loan is funded, not before. So they have to maintain control wherever they can and trust the actual documents less and less. It's unglamorous advice. The financial equivalent of checking that the bridge loan is actually anchored before you step onto it. The trouble is that the entire market has been walking across at a speed, assuming someone else has already looked down, but they haven't. So that means more lenders are going to come down as this cascade of private equity fiasco that started with First Brands and now is moving from auto parts manufacturing into real estate in the UK. It's going to get uglier. So be aware of what's going on and understand that this is going to increase credit risk. Banks and non-bank lenders are going to go off, no risk. They're not going to want to take risk as they're having to show their shareholders that they're losing money. So with that being said, thank you so much for watching. The Economic Ninja is out.